Hey there, CRNAs. Welcome back to Money Moves for CRNAs, the show that helps 1099 nurse anesthetists like you keep more of what you earn and turn taxes into opportunity. In Part 1, we talked about how CRNAs can cut taxes and build wealth. From maxing out your solo 401k in those big earning years, to using Roth conversions when you slow down and grab that senior deduction. Today, we're closing things out with a smart move most people miss. How to actually use market dips to your advantage. Let's get into Play 3 and turn downturns into opportunities. Here's your host, Randy Larkin, CPA from Atlanta Tax Planner.
Hi, welcome back. Play 3. Use market drops. Now, let's talk about recessions. Nobody likes them. The market dips. Your retirement account looks smaller, and it feels scary. But here's the twist for Roth conversions. Downturns are actually an opportunity. Why? Because the IRS taxes you on the account's value today. If your $250,000 account drops to $170,000 in a recession, you convert then and pay tax on $170,000. Later, when it rebounds to $250,000, all that growth that happens inside your Roth is tax-free. Think of it like paying tax on a small suitcase, then stuffing it full of clothes later for free. The trick is not to try to time the bottom. Nobody can. Instead, convert in chunks during downturns. That way, you average into the discount and catch the rebound tax-free. Why CRNAs win big with this? As a CRNA with an S-Corp, these strategies hit even harder than for most people. Here's why. First, payroll and income tax relief. Traditional 401k contributions cut your taxable wages and are your K1 amount, which means smaller tax payments. 2. Retirement control. You're not stuck with a hospital plan. You're the boss. That means you pick your salary within limits, your contribution type, and your timing. 3. Tax flexibility. Having both Roth and traditional accounts gives you options in retirement. You decide which bucket to pull from depending upon your tax situation. 4. No forced withdrawals. Traditional accounts force you to take money out at 73. Roth IRAs don't. Converting early puts you in control. Wrap up. So, CRNAs, here's your tax playbook. First, in your $350,000 full-time years, load up traditional solo 401k contributions to cut your tax bill while you're in the top brackets. 2. In your $180,000 part-time years, start converting into a Roth. If you're 65 plus, grab that senior deduction while it lasts from 2025 through 2028. Third, when the market dips, don't panic. Use downturns to convert at a discount and let the rebound happen. Tax-free inside your Roth. The Roth IRA isn't just a savings bucket. It's a strategy. And as a CRNA with an S-Corp, you've got more control than most people. So the next time you see your tax bill or your retirement account balance, remember, you've got tools, you've got timing, and you've got a plan. That's how you turn taxes into opportunities and make your money work for you, not Uncle Sam.
All right, That wraps up our CRNA tax playbook. Delay taxes when you're earning big, convert when your income's lower, and use market drops to grow tax-free. If you found this helpful, hit subscribe and share it with another CRNA who's ready to keep more of what they earn. And don't just listen. Start applying what you've learned. Talk with a qualified tax advisor, map out your plan, and take the next step toward financial freedom. Until next time, work smart, save more, and take control of your money. Music licensed from premiumbeat.com. Under license number 7394047.